Alrighty, this is the official video numero uno of chapter 2 of my crazy prop trading journey. Now, if you're sitting there wondering, hey man, why are we on chapter number 2? I highly recommend you check out the entire recent series and also the most recent video of why I had to start over. But the TLDR is this: for a couple months there, I was trading well and my accounts were going pump, 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 pump. And then out of nowhere, everything exploded in my face. There was fiery debris. It was this whole saga. It was very painful. So if you want to see my misery that will forever now live on the internet, I highly recommend you check out those videos. But like any good bull would do, it is time for me to move on to greener pastures, which brings me to this video where I'll be explaining exactly why I picked the accounts that I picked. I'll be answering some of your most common questions, and most importantly, I'll be sharing some insider secrets. I'll be pulling the curtain back on how you can easily pass some of these evals, because trust me, it's definitely not as difficult as it's pitched to be. If that sounds good to you, I would truly appreciate it if you could like, subscribe, turn on your notifications, all those good things. And with that being said, let's rock. To kick off the second chapter of this journey, you can see that I've decided to go with the 50K accounts, and obviously I max them out. I do have 20 of them, and this is really a good place to start because it's probably one of the first questions I always get is, first of all, why the 50K accounts? When you come to Apex, you'll be able to see you have 3 different data providers. You could either go with Wealth Charts, you could go with Rhythmic, or you could go with Tradevate. I've always gone with Rhythmic, well, first of all, because Wealth Charts is brand new and I'm not really that familiar with it. So for most of the time that I'm here, it's either Rhythmic or Tradevate, and I went with Rhythmic basically because it was slightly cheaper, and on top of that, I'm trading on a PC. From what I've heard, Tradevate is very good if you have a Mac or if you want to trade on your phone, but I'm always trading on my PC, so I figured why not just go with the cheapest option. And I also should just note that Wealth Charts is new, so it might be clearly the best option. I'm just not the most familiar with it, at least as at the point that I'm filming this video. So let's just say, hey, you pick the good data provider that is appropriate for you. The next logical question is, which account should you go with? This is kind of up to you, but I'm just going to share my thoughts. Of course, I should preface all of this of always use the optimal option for yourself. If one account is better or worse for your trading style, well, you should note that and clearly just lean on the ones that are a bit better for your own trading style. So I just really want to say that from the onset. But right here, why I like the 50K accounts. I want to run you through some of these numbers and why I personally believe it's optimal. First, to go to a PA account, you have to pass the eval. So we have to consider, okay, how easy is the eval to pass? And then from there, is something better or worse for you in your trading style? To pass on a 50K account, you have to hit a $3,000 profit target without suffering a 2.5K unrealized drawdown. All right, that's good. That's the line in the sand. But when you compare that to the 50K account, the profit target doubles as the account size does. But you notice what doesn't? The trailing threshold. So the profit target 3K to 6K, okay, 2X, that makes sense. You would naturally assume that the trailing threshold goes all the way up to 5,000, but it doesn't. And the fact that you have less of a trailing threshold, well, maybe not so good for you as a trader. And then from there, 50K to 150, well, you would expect that to 3X. So 3K up to 9K, cool, that checks out. But at the trailing threshold, you'd expect that to be 7.5K, and it's not. It's 5K. And in fact, the ratio doesn't even really improve from the 100 to the 150. So right away, I see that the profit target, what you need to pass the test, is linearly going up, but your drawdown, kind of your buffer zone, not as much as you think it would. And I should also note, this doesn't personally impact me, but just in case you're a person who's trading a lot of contracts, the contracts also don't scale. It's not like we go from 10 to 20 to 30. We're going from 10 to 14 to 17. So another thing that's not necessarily scaling in your favor, but the last one, the contract size, I should note, I'm trading 1 or 2 contracts at most, so that one doesn't really matter to me. But I just want to point that out, that from just a ratio perspective, how much you need to make and how much drawdown you're afforded clearly is getting worse the farther up you go. So I just wanted to point that out, and that's exactly why I picked the 50K. Now, if you happen to be a trader and you're like, you know what, I don't really care about the profit target because I'm in it for the long game and I just need to have more of a trailing threshold, and you like to max it out, I totally get it. In a general sense, I became very comfortable with the 50K just because generally they were the cheapest and I like the ratio, that I've now traded on them so much that I'm kind of just psychologically biased to them just because I put in the most effort to kind of give them a shot. If you saw the starting over video, you know, I was like, all right, maybe I'll try the 150K, but really I just didn't like the ratio. I found that the ratio had too much of a disparity. It's just not quite for me. So once again, I'm exclusively speaking for what works for me, and I do implore you to find out what works for you best. best, but I just wanted to point out these ratios that theoretically it is far easier to pass this one on the ratio between the profit goal and the threshold rather than these bigger accounts. And if you don't mind, I'm now going to use this time to answer the two most common questions that I get as it relates to SIMDA funded trading and specifically Apex. A lot of people, when you come to this website, you see this: receive 100% of the first 25,000 per account and 90% beyond that. When they say per account, they mean per sub trading account, not just you as a user. So it's not like you get the first 25,000 and then after that it becomes a 90-10 split. That is true, but it's true per account. So if you have 20 accounts, the first 500,000, 20 times 25,000 is yours. And then after that, it's a 90-10 split where you, the trader, get to keep 90% and then Apex gets to keep 10%. And now for the second most common question I get relates to the confusion or maybe a little bit of contention to Apex's 30% consistency rule. There's more so confusion about what it is and what it isn't. So I do believe I could explain it pretty simply. No individual trading day can account for more than 30% of your total profit. So let's say you've been trading for whatever, 10 days, and your total net profit is $10,000. No individual day is allowed to account for more than 30%, in this example, $3,000 of that entire situation. So if you get there 1K, 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 that's completely fine, 10 days at 1K. But let's say there was some bigger days and some losing days, that's completely fine, as long as one individual day doesn't account for more than 30% of the total net profit. Generally, from there, I get the follow-up question of what happens if your single largest winning day is more than 30%? Do you lose your account? And the answer is clearly no. Nothing happens. You don't lose your account, but you're also not going to get your payout approved. All you have to do is keep trading to grow your total net profit, because what you're looking to do, you take your single largest winning day and you divide it by your total net profit, and then you're going to get a percentage. If that's above 30, you're in a no-go situation. You don't lose your accounts, but you're also not going to get approved for a payout. So what you have to keep doing is trading to balloon your total net profit. So the ratio of your largest winning day divided by your total net profit goes below 30%. And then once again, your accounts are going to be in good standing and you'll be able to get approved for your payouts, assuming you follow the other rules as well, such as you've traded for at least 8 days and all the other various things posted in their FAQ. So what does this all actually mean, especially if you have a blowout, amazing, huge profit day? You're not going to be in trouble. It just means you have to keep trading, i.e. keep showing consistency, and then you have to come below that 30% mark and you're going to be completely fine. All this information I just hit you with related to the payouts and the consistency rule, that's all under the assumption that you have a PA account, i.e. a performance account. And to get to a performance account, you have to pass the evaluation. To pass the evaluation, I know there's a lot of negative emotions related to it. There's a lot of fear mongering, and there's a lot of people that have what I feel to be some unjustified, anxiety or fear, or really a misunderstanding of the difficulty. Now, from the onset, I should probably say that yes, trading is difficult. You shouldn't be trading in the real world, figure out that it's difficult, and then come to SIMDA funded trading and think it's magically going to be easier. Yes, trading is just straight up difficult. I'm not trying to, pull the wool over your eyes on that particular one. But to be fair, I think we should specify where that difficulty is. And in my opinion, it's clearly in the PA account. When it comes to the evals, it truly isn't difficult. In all reality, if you look on Apex's website and other places on the internet, the pass rate is just below 50%, which might get you to scratch your head and be like, wow, I'm not passing basically 1 in every 2. How are people doing this? The fact that Apex has a 1-day pass rule means you can just kind of YOLO it that day. It's not like these other ones where you have to trade 1 day, 2 days, 3 days, anything like that. If you crush it in 1 day, you can pass that day. And then that gets to the interesting math question of, well, how can you aggressively pass it in 1 day? You didn't hear from me. A little birdie told me that a very efficient way to do this, maybe not efficient from a cost standpoint, but efficient from a time standpoint, you have to wait for a big event, such as an inflation data point, an FOMC meeting, an unemployment report, any of that stuff where we know in the short term, there's quite a bit of volatility. And what you have to do is you look at the max number of contracts you could trade, you look at your profit target, and you say, okay, I want to pass one of these tests. So you buy 2 accounts and you don't know which way it's going to go, but the odds are pretty good if you bet long and bet short. Of course, there's some weird data issues, and there's also the risk that maybe it just doesn't go that far or goes that far and then pulls back and you blow out. But on a lot of these, not all the time, there's a big enough movement from right out of the gate that whether you were bullish or bearish, you're gonna pass in one of them, and of course the other is gonna blow out. So is this a foolproof plan? Is it the most cost-effective plan? Absolutely not. But like I said, I'm not condoning this. I'm just saying that I read about this on the internet. I heard about it on the interwebs, that there's a lot of people out there who wait for highly volatile events. They rip it long, they rip it short simultaneously, and there's pretty good odds of at least half of them passing. Now, I want to make this point very clear. I'm not condoning it, and it is not financially efficient. It's obviously time efficient if you can actually pull it off. And I should also clarify that this will not work on PA accounts. As soon as you're on a performance account, if you were to do what we're hypothetically talking about, you will not get a payout. You cannot degenerately be waterfall trading these big events. But it seemingly, from what I've heard, does not matter in the eval stage. So I want to be very clear about that. It should also be noted that for any of these other SIMDA-funded companies, specifically the ones that have the consistency rules on their eval, obviously this tactic would not work. And there's also a lot of them that don't even allow you in the eval stage to trade any of these highly volatile events. So make sure you're checking out the specific rules. I should quickly note that if you choose to engage in this form of degeneracy, or really any other degeneracy when it comes to SIMDA-funded trading or the stock market as a whole, it is exactly that. Inherently, if you still don't have a sound trading system, you're not going to find success. So of course, there's little corners that you could cut here and there, but to be overall successful, it still comes down to, do you have a good system that you are executing in a disciplined manner? Without a system, without discipline, all roads lead to failure. So yeah, you might be able to speed some things up here or there, but that's not the bigger picture. Yeah, you might be a bit more efficient, but the bigger picture, to have those major levels of success, it always comes back, do you have positive expected value within the market, and are you executing upon that? Which is an absolutely perfect segue to the most important part of this video, my plan moving forward. Over the past week or so, I've been spending a lot of my time modeling how my system should theoretically perform on a 50K account, and I kept coming back to the same major issue. As previously shown, if you choose to use a 50K account, you only have a 2.5K drawdown, which isn't much. In fact, it's only 5%, and it's very, very difficult to find a trading system that never has a 5% drawdown. When I started to dive more into that specific aspect, it became pretty apparent that there's only two solutions. Number one, instead of trading minis, I could trade micros and slowly build it up and just obviously apply the same system, but really just allow myself a bit more leeway. That's probably the proper answer. That's probably the conservative answer. That's probably the smart answer, but that's not why you come here. And in reality, I don't like how that makes me feel. It's boring. I want something that's high octane. I want something that gets my blood rate going. So I really don't want to trade micros. Like I said, that is the smart thing. That is the conservative thing. That is the thing that I should be doing. But I just don't find it to be fun. I still want to trade the NQ minis. So if I'm refusing to trade the smaller, more conservative contract, the only other option is to build up a pretty large buffer. Most of the back of the napkin math that I've been doing suggests that I need about a 10K buffer, as in I need to grow the 50K accounts all the way up to 60K before I can really start trading my own system that I'm pretty comfortable with. So that leads us to the golden question. How am I going to get 10K, and how am I going to do it in a consistent manner? And in all reality, I don't know. That's what the first part of this particular series is going to be. That's going to be the first couple paragraphs in this chapter. I'm going to see if I can aggressively trade, and I'm hoping, I'm praying that the market environment is a ripe one with good volatility, with me being on the right side of the trend, that I can pull something off like a 5 days of 2K or 10 days of 1K or maybe something mixed in there. But what I need to do is aggressively try to get to that 10K buffer so I can trade my normal system. For me to be able to pull off this buffer build out phase or whatever we're going to call it, obviously I'm going to need a little bit of luck to be able to overcome variance. What I mean when I'm saying that, I think is best described by a poker metaphor. For all my poker players, you know that when you sit there, you want to be dealt pocket aces. It is the strongest starting hand, but you also know that there's no guarantee you're going to win. Of course, you want to start with that, and hopefully the flop and the turn and the river come your way, and obviously there's other things to continue, but you get my point, is that even with the strongest starting hand, you still might lose. And that's the same thing in trading. Just because you have the best setup doesn't necessarily mean you're going to have a profitable trade. So here's my plan. I'm only going to trade those A+ setups. No Bs, no Cs, no Ds, nothing like that. I'm going to be waiting to be be dealt those pocket aces. And when I see that happening, I'm going to be betting aggressively. Now, of course, there's quite a bit of risk to this because aces don't always hold up. You can easily get cracked. If this happens to go against me, I could easily blow these accounts up because once again, I have no buffer. But I'm going to be hoping that variance doesn't come for me. And when I wait just patiently for all these A+ setups, I'll be betting aggressively, hoping I don't get cracked, hoping that if I can catch 3, 4, 5 days of these good setups, I'll be able to quickly build out that buffer. And then I'll be able to return to not so much degeneracy and just go back to my normal trading system. With that being said, I obviously have no clue how many attempts this is going to take me. I may be able to pull it off on the first attempt, or like just going with this metaphor, my aces might get cracked and it might take me 2 or 3 or 4. But my goal is to, as quickly and efficiently as I possibly can, run up to a 10K buffer so then I can return to my quote unquote normal trading methodology, where I'm just going to feel a little bit better about having that buffer and I'm not going to be so worried about variance in my normal system coming after me. Or to put that another way, I'm looking for a little bit of degeneracy right now to ideally have a more sustained run after I could get over that first hump. If you want to see how this plays out in real time, I implore you to check out the live show Monday to Friday, 9 to 11. I'm trading these accounts in front of all of you. Or if you want to just come back and check out the future videos in this particular series, I'll be as transparent as possible. If I'm blowing up, if I'm having success, something in the middle, I'm going to be reporting to all of you, nothing hitting, exactly how every single step of this plays out. Obviously, I hope you enjoyed this video. I hope you're enjoying the start of the new series. Don't forget to like, subscribe, turn on your notifications, all that good jazz, and I'll catch you in the next update. I appreciate your time. I appreciate the good vibes.